All right, we made it. Strategy number 2, subject to. I don't know how many twos I'm going to say in this presentation, but it's going to be a lot. Summary, subject to is when an investor or purchaser takes rights to the title for a property while the seller's existing mortgage stays in place. Okay, so going back to the same scenario about buyer and seller, the buyer actually buys the property. But what happens in this case is that the seller's mortgage actually stays in place. Okay, so the buyer is buying the property subject to continuing to make the payments that are already in place. And so if you remember, when we're talking about seller financing, we said that easy way to remember seller finance is that you create a new payment. Buyer and seller come together to create a new payment. Okay, all the terms are negotiated, which creates the new payment. But in subject to financing, the buyer continues to pay the seller's existing payment. So seller finance is new payment, subject to is existing payment. Easy way to remember and not get these two twisted. All right, let's jump into a scenario again. This is our same characters here. We got Jim, Jim's realtor, Deborah, and we got Judy with her realtor, Glenn. Same property, same sales price, just different type of sale. So Judy actually owes money on this property now. And in the first scenario, she owned it free and clear. Now, Judy has a mortgage of $350,000 with a 3% interest rate. Judy's monthly payment is $1,500 per month. Her home is listed on the market and she is asking $400,000 for the property. Now, as you can see, Judy doesn't have a ton of equity, right? 50,000 on 400,000 is not a ton of equity. Judy just bought this house like 2 years ago, so she got a really great interest rate. Today, the interest rates are about 7% as of this recording. So why this is attractive is because Judy not having a lot of equity, okay, and she needs to get out of the property. She's actually moving states. She lost her job. So right now, money's not just flowing, right? Money's a little tight. And so the sales price being 400, Jim is going to come in and he's going to give Judy her remaining equity in cash. Jim's going to put down $50,000, okay? 12.5%. So Jim is going to give Judy her remaining equity of $50,000, and he is also going to assume, meaning not, when I say assume, he's going to continue paying the current $1,500 payment. So Jim is going to buy Judy's property by giving her $50,000 down and buying the property subject to continuing to make the $1,500 a month monthly payment at a 3% interest rate for an allotted period of time. So in this scenario, you are still going to use a title company and you're still going to use an escrow company. So remember, title does the initial transaction. So for the actual sale, they're the third-party intermediary, and then all of the payments and facilitation, the servicing of the deal happen with the escrow servicing company that is after the fact. So title company to do the sale, all the payments and accounting is done by the servicing and escrow company after the fact. So that's a quick high-level overview about a subject to transaction. And now we're going to dive into a little bit more of the details with most commonly asked questions about these types of transactions. So are agents still compensated? Absolutely. There is no reason why you represent a buyer or a seller with a subject to transaction and you as an agent are not compensated. Do you have to use a title company? Technically speaking, no. However, I would not recommend, nor would I do a subject to or any creative finance transaction without using a title company. Do you have to use state forms? You do not have to use state forms. However, you do want to check with your E&O insurance because there is a high likelihood and probability that they will only cover your state forms. And you're also going to want to check about the legalities around subject to, not only with your state, but also with EXP's regulations and policies. Who creates the terms? So the terms, again, are created by the buyer and the seller, right? It's all negotiable. However, in subject to transactions, you have to have a mortgage. If there's no mortgage, then you can't really do a seller financing. Excuse me, you can't do a subject to transaction. It doesn't work. There has to be debt in order for it to be a subject to. So the only term that you're really not going to see negotiated too much is that monthly payment has to get made. So at minimum, one of the main terms of the deal is that that monthly payment is going to be taken over and made on behalf of the seller by the buyer. Okay. Are inspections required? No, inspections are not required. However, I would highly recommend buyer and or seller get inspections done. And if they don't want to, I would definitely put it in writing that you recommend that they do. But no, inspections are not required and neither are appraisals. However, either the buyer or seller can request one and they can negotiate and agree upon who's going to pay for it. Who services the loan after it closes? That is going to be the servicing company, escrow servicing, same thing as with seller finance. What is a call date or balloon payment? It doesn't change from seller finance to subject to. At some point, the buyer is going to have to pay off in total the current debt on the property. So it could be 1 year, it could be 5 years, it could be 10 years, it could be 30 years. It just depends on what the buyer and seller agree upon. But yes, there's going to be some type of call date or balloon payment in a subject to style transaction. Is this legal? I cannot say if it's legal because it's going to vary from state to state. However, in subject to transactions, you must know is that the seller, if they have a current mortgage in place, there is a 99% chance that they are violating the due on sale clause. Again, that is another training from their time, but you got to know that part at least. And also, if you have questions about is subject to legal in your state, this is something I would recommend speaking with your state leadership team at eXp Realty. How does the seller qualify the buyer? Well, the seller qualifies the buyer however they see fit. So in those scenarios, it can be as simple as a conversation or as complex as what a bank would normally ask for. Proof of funds, credit score, bank statements, tax returns. It's really just whatever the seller needs to feel comfortable to facilitate this transaction with the buyer. Okay, cool. Before we jump into the pros and cons, just one more time. Every situation is different and presents a different level of complexity. So before engaging in any type of creative financing style of transaction, it's important that you understand your state laws and eXp Realty's policies regarding creative financing and adhere to those policies and laws. For assistance, make sure you reach out to your state broker and leadership team. Okay, we made it. Subject to pros and cons for the buyer and for the seller. So let's start with the buyer. We'll start with the pros. Sometimes low interest rate. Now, if you go back to the original transaction here, what's really attractive for Jim in this scenario? It's this 3% interest rate because today the interest rate's 7%. It is almost impossible to get a 3%, except it's possible in a subject to style of transaction. So when you think about what's in it for Jim, well, this 3% interest is a major factor. Now, the interest isn't always going to be a super low interest rate. However, if it's lower than what you can get on the market right now in the mortgage world, well, then it's going to be a pro. And sometimes you literally are at 7% and you can do a subject to transaction for 3%. So sometimes you get to capitalize on an unheard of low interest rate. Better amortization, going right back to the same scenario. Okay. Remember, Judy owned this property for about 2 years. Okay. Judy owned this property for 2 years. That means she's been making principal and interest payments on this property for 2 years. Amortization schedules are front loaded with interest. And as time goes on, the interest dwindles down, right? More principal, less interest. So Jim is jumping into this amortization schedule that's already been paid on for 2 years. So in this case, that payment is more principal and less interest now than it would have been if you would have started it from day one. So not a huge advantage, but definitely an advantage nonetheless. So no appraisals are not required. However, the buyer and the seller, if they want to do that, they can. There are no lending fees involved because there is no mortgage company. So that is a saving for the buyer. And sometimes no qualifications needed. And again, not promoting or condoning no qualification, just saying that sometimes the seller does not ask for much. And last but not least is low down payment. Now, a low down payment isn't always going to be the case, but when you deal with a property like this, and you only have $50,000 of equity, even if you gave them every last dollar of equity, it's only 12.5%. So again, I'm not saying that's a lot or a little bit, but if this number was 380, it would only be $20,000. So again, subject to, because a lot of the transactions are facilitated because there's some type of financial pain, usually there's not a whole lot of equity. And so that can mean that the buyer would need less of a down payment to buy the property. Okay, let's jump into the cons. And as you can see right off the bat, there's not a lot of cons here, right? If you think about it, the buyer gets the low interest rate, potential for a low down payment, no appraisal, no lending fees, technically no qualifications needed. Not a bad deal for the buyer, right? So what are the cons? Well, the one con is that you have to pay off this mortgage at some point, right? So the mortgage that's in place, Judy's original mortgage, you're going to have to pay off that total balance at some point in the future. So again, not a huge con, but definitely something you need to be aware of and know that that day is coming. And then a lot of times, again, because you're giving this buyer a pretty good deal, there's not a lot of downside for them. Sometimes the seller will ask a little bit more for the property or even a little bit more above retail. Because remember, there's no bank involved, so there's no appraisal. If the buyer wants to buy it, you can sell the property for whatever price you want. So a lot of times, because a seller either really needs the money, like they need to get the most that they can, or they just know they're giving a great deal, they're going to maybe mark it up or at least pay retail or at least charge you retail on the value. Now, that's not every single time. That's not how all subject to transactions work. But when I'm thinking about what are some of the downsides, that could be one of them, that you're paying a little bit above retail. But again, it definitely outweighs the benefits that you get here. Like it's, paying a little bit above retail and getting all these benefits. These benefits definitely outweigh paying retail or paying a little bit above. Okay. Now let's jump into the seller. What's in it for the seller? What are the pros? What are the cons? So number one, quick close. You can close quickly. That's great for everybody if that's what the deal calls for. Someone takes over your monthly payment. So if you need, financial help, if you're stressed out, if you're falling behind on payments, you're a seller, someone's picking up that tab now. Someone's paying that mortgage every month on your behalf, and it gets that burden off of you in terms of that monthly payment. So the seller also has recourse if the buyer doesn't perform. So if the buyer stops making payments or is unable to make payments, the seller does have recourse to take the property back if the buyer does not perform. And when they take that property back, they keep all the down payment as well that you initially, as a buyer, gave them. And most of the time as a seller, because we're not dealing with high equity situations, like we're not dealing with a lot of equity in the property, you most of the time get pretty close to getting all of your equity out. Now, again, not every single time, but more times than not in a subject to transaction, the seller is getting a pretty good amount of whatever equity they do have out of the property at closing. Now, let's jump into the cons. Number one, the debt stays in your name. Arguably, probably the biggest con is that the debt still is in your name. So if you were sell your property on subject to and then go try to get qualified for another mortgage, that payment and that debt is going to count against you on your debt to income ratio. that poses a problem for a lot of people. So you have to know the debt does technically stay in your name. Number two, there is always a risk of foreclosure, meaning that you could have to take the property back and catch up on whatever payments are late, and whatever condition the property is in, you also would have to deal with that as well. We hope that never happens, but it does happen, and so that's definitely a risk. And then last but not least is that you as the seller have to know that by selling this property in a subject to style of transaction, you are 99% of the time violating the due on sale clause of your mortgage. So something to be aware of. And again, that's a whole other training for another time, but that due on sale clause is most likely being violated. So that is everything about subject to, the pros and cons for buying the seller. I hope you got a lot of value out of that, and any feedback would be greatly appreciated. Thank you again for tuning in to eXp University Creative Finance.